Rocking into April. Now, a lot of things happen over this weekend on the sports scene. By the way, this is Market Call. Guy Adami, Dan Nathan there. It is Monday, April the 3rd, 1 p.m. on the East Coast. In just a minute, we'll have the great Carter Worth of Worth charting. This Market Call brought to you by FactSet Financial Data and Analytics. They're, in fact, powered by Tomorrow, Dan. They're also our data provider. By the way, subscribe to our YouTube channel. What do you smash something or subscribe or smash the like button? Do something.
Like it.
Yeah, whatever you people do. You do a great job. So there were a lot of sports this weekend, and one thing actually made me happier than anything else. And it was not the Mets losing. It wasn't the Yankees taking 2 or 3. It wasn't the Rangers winning yesterday. It wasn't the Knicks winning yesterday. It wasn't LSU beating Iowa in the women's final. It was the U losing and not making it to the final game tonight. UConn throttled them to put them out of their misery. As you could probably tell, I'm not a big fan of the U or the people that walk around, doing those signs all over the place. I don't know when they got the name the U. I don't know why they think of themselves as the U, but they are the Gone now. How are you, Dan Nathan?
I'm doing well. Guys, it's the first week of April. It's the first trading day of April. It's the first trading day of the second quarter. And let me tell you, we've been documenting it. You and I have been fighting it a little bit. What we try to do here is, let's call it demystify. A little bit about like what the headlines are, what sentiment is, what the charts look like. That's why we have CB Dubs, who joins us twice a week here. You and I are not always going to be right. We felt right about a bunch of stuff as it relates to the economy, as it relates to the deceleration of the economy. I got the market wrong. We had some good trades. We had some good directional stuff, but that happens here. And again, you know what? I think we're going to kind of make up for it in Q2 a little bit. And it kind of reminds me of this, this great lyric guy from April Come She Will, by the great Simon and Garfunkel, when streams are right and swelled with rain. Wow. I feel swelled with something right now, but we're gonna make Q2 rain here, people. Okay, that's just gonna happen. And I actually think, Guy, a lot of the stuff that we've been pointing out is gonna come to fruition. I think the markets were just not pricing it in. Somebody emailed me, because I think I said it on Fast Money last week. I said, the market's acting in a way without any fear in an environment, in an economic environment that should be just kind of like putting the fear of God in sorts of investors. And so thoughts on that notion, because that's how, listen, we saw this as the calendar turns. Sometimes sentiment shifts on that one functionality. It happened on January 1st. It might happen again on April 1st, Guy.
And it's interesting. If you were just looking at the Dow today, you'd think the S&P was up 30 handles. And if you were just looking at the NASDAQ today, you would think quite the opposite. And the Russell's probably somewhere in the middle. The VIX nowhere north of 19. It's a fascinating day to start the month, but I think your points are valid. There is zero fear. Forget about what the VIX measures. And just in terms of the complacency out there, all the things that we talk about every day doesn't seem to be registering with some of the participants, specifically probably the passive investing, not crowd, but phenomenon. And, that quarter end, month end on Friday, it was also some sort of rebalance, like some 5-letter thing that I probably should have heard of, but never have. Doug Cass pointed it out, that the financial media wasn't talking a lot of it, but all those things contributed without question. But then, and we'll talk about this in a second, you get the news out of OPEC, which we'll address in a few minutes. All these things continue to point to, the negative sentiment. And then coupled with our first shot, our first screen, full screen, as they say, this ISM, which came out, was an unmitigated disaster. And the fact that, the Dow stocks are as strong as they are on the back of that, it doesn't make any freaking sense to me. These are levels we last saw, 3 or 4 months into COVID in June or July of 2020, I think. It's fascinating to me how the market seems to discount everything, and we have a number of people that were addressing that today, Dan.
Yeah, I guess let's take a look at Jim Bianco, and guy, that's a guy we got to have him on the Tape podcast.
JB,
he comes on Fast Money, and he always does great work, and he's very data driven, just like the rest of these folks that we have these tweets up here, Liz Ann Saunders, and obviously our Liz Young, EY from SoFi, who is a co-host with us on this fine market call program on Thursdays and also on Monday's pod, which just dropped, our Monday OTT pod. Actually, guys, go check that out. Liz Guy and I had a great conversation. There's not going to be any overlap, actually, of what we talked about here, because this is a very visual medium. We also had a great conversation with Caleb Silver. He is the investor, or the editor-in-chief of Investopedia, and he had I thought that sentiment survey that they did of a lot of their listeners is really interesting, the things that they're most focused on. So check that out in the podcast store. But here's Jim Bianco guy. So he's talking about this ISM reading, and he said 75% of these instances, this is the economy has either in a recession or about to enter a recession. He's talking about since 1948, as this chart shows. This is the 16th time the ISM has been 46.3 or lower. 12 times, 75% of those instances, the economy was either in a recession or about to enter a recession. So I guess the question I have for you is that we are not in a recession. Okay, we know that right now. We might be entering a recession. We won't know for 2 more quarters, right, whether we are in a recession and how long and how deep that recession is in. Like, do you want to buy stocks with the S&P up 7% on the year and up a lot more from the lows, right, in October, and the NASDAQ up 16%, and the NASDAQ 100 up 20% again on the year, up a lot more from the lows? Do you want to buy stocks with an indicator that is screaming that we are very likely that there's a 75% chance that we will be in a recession in 2023? You want to buy stocks?
Yeah, I mean, I mean, there probably are times historically, and I can't speak to that, but when stocks were troughing into it and valuations were reasonable, so maybe you could get ahead of something. In this case, I think quite the opposite is true, where obviously inflation is a problem. The Fed has just raised 9 months, almost 500 basis points or so. The lag effects have not been felt yet, despite the fact that, this ISM number was a disaster. Maybe that's the beginning of feeling that lag effect. And valuations are expensive in a weird interest rate environment with all the geopolitical risks that are out there. And people seem to be saying, you know what, it's fine, just buy stocks, because historically that's been the right thing to do. Other than the fact that the market is, in my opinion, considerably expensive, this entire move has been based not on fundamentals, but multiple expansion. And that can only last so long, Dan.
Yeah. Well, it's funny, you go back to valuation, and, Mike Santoli on CNBC, who does a lot of heavy
yeoman's work.
Yes, he does. He pointed out that the equal weight, and he's done this a bunch over the last month, and I think it's great data. And he does, like you said, he does a great job and does a lot of heavy lifting on that network here. But he pointed out that the equal weight S&P 500, okay, so if you take out those top 6 names that make up 25%, the multiple basically got down to about 14 at the lows in October, which is, when we've talked about what's a trough multiple for the S&P 500. Now, that is just kind of cherry picking, right? Because a big earnings contributor to the S&P 500 is obviously those big names.
That's right.
Okay? But he's trying to make the point that there's hundreds of stocks that got into the low teens, right? And below that as far as multiples are concerned. So valuation's a tricky one. And I guess the other point, that I would just make about the market, to me, it's more sentiment. It's more that we have a 19 VIX in the middle of a banking crisis that is not over by any means. And we're going to talk about at the end of this show some other ways in which that might be reflected. But here's the big one. Geopolitical has been one of the huge reasons why we've had this bout of inflation. Forget about the Fed and what central banks have been doing, right? A year ago at this time, crude oil was partying because of Russia's invasion, right, to Ukraine, and uncertainty about flows of energy and the like. And look at what we wake up this morning, and we have this surprise cut from OPEC. And look at this chart. And Carter's going to walk us through what he's seeing in the commodity index. But look at that move from 18-month lows to almost its 200-day moving average on one headline, guy.
And, surprise cut, and people will watch this and say, OPEC is sticking it to us. And it's true. And believe me, I'm not siding with OPEC here, but what do you expect them to? I mean, if anybody found this to be surprising, especially the administration, they're just not paying attention. Of course, there was inevitability to this thing. I mean, when we tap from the SPR, we're effectively doing what they're trying to do as well, price control, right? So it doesn't really surprise me all that much. The move higher doesn't necessarily surprise me all that much. Actually, Carter sort of, as you said, previewed this last week. We traded basically up to the 200-day, maybe just short of it. We'll see what happens. But to me, this is the precursor of what I think is going to be not necessarily for the underlying commodity, but a pretty robust time for some of these energy stocks. But it just makes, again, going back to what you were saying, just makes this Federal Reserve job that much more difficult, because obviously this is a big input on the inflation side. And if crude and the underlying products are going to get back on their horse, it's going to be a problem. And you said something earlier today. You filled your truck up, and for the first time in a long time, that number had a $100 handle on it. And I think a lot of people out there are seeing the same things. Very quietly, inflation inputs are trending the wrong way for the Federal Reserve, and quite frankly, for the citizenry of this country.
Well, and it's a really good point, because the other thing is that McDonald's just announced that they just sent all of their U.S. employees home, and they're going to be announcing layoffs. It's coming at a time where we have this unemployment number on Friday, on Good Friday, when the markets close, coming up, where I think there's going to be increased trepidation about wages, about the job security. And, really since that bank run in Silicon Valley Bank and the other failures, last month, we've seen a deceleration in a lot of consumer behavior. We've seen consumer credit go up. And this is at a time where interest rates, I know that, the 10-year had been volatile, the 2-year had been volatile, but lending rates are still they're still high, much higher year over year. So this is all coming to a theater near you. This is what I think causes the S&P to go down in the year in the not so distant future. The NASDAQ, obviously, that might be a much taller task. It would have to be a much harsher recession than maybe some are forecasting at this point. But I'm sticking to my guns here. Guy, really quickly before we get to Carter, the S&P, it picked its head up just briefly, above the downtrend that's been in place from early 2022. And the NASDAQ is just a different looking chart than this one. This is make a bit of a pennant. But if you look at this one, it had gotten below that or above that breakdown level from, last spring of 2022. And again, this doesn't make me any more bullish. It's just that these charts look, I guess, a bit more constructive. Let's bring Carter in. He's going to do some heavy lifting on the S&P chart, and we're also going to look at commodities and, of course, Tesla. Carter Braxton Worth,
guys, how are you?
Charting. How are you? But wait, Carter and I had an epic night on Saturday.
We did.
With our wives. We were in the Madison Square Garden watching Bruce Springsteen and his amazing 17-piece E Street.
3 hours without a break at 73 years old. Pretty impressive.
It was epic, right? You and I had to even take a seat towards the end when he went a little acoustic.
Yeah.
Just so you guys know, and Guy was invited. Just he said, "You guys go have a ball." Isn't that what you said, Guy?
Pretty much.
Go have a ball.
Long hair at the Madison Square, and Dan sent a picture. You probably should put it out on the Twitter. It's lovely. I mean, and you're going tonight to see Bruce Springsteen at like Barclays Center or somewhere in Brooklyn or something, right?
I am going to see.
I'm going to see him
twice in 3 days here. That when he got the E Street Band back together in 1999, they played something like, I want to say 11 shows in the month of August at the old Brendan Byrne Arena. Do you remember that? And
I do.
And I think I went to half of them. I think I went to like 6 of them. I went to Hartford. I went to Albany that summer. I was all over the place. So it was a heck of a lot of fun. Carter, was great being there with you and your wife. All right, let's do this thing. Carter, let's be business-like here. You're going to go through the S&P. You did have this preview note of the commodity complex that went out on Worth Charting Friday afternoon. That's why you guys have to be on that email list. And then we obviously are going to talk Tesla. So run us through the S&P here. I mean, again, Guy and I
just starting with what you guys are talking about. I mean, it is multiple expansion, just to be clear, right? And that's what's driven the market itself. To start the year, right, was at sort of 17.5 times, and now it's 19.5. That's not much multiple expansion. Now, at the start of the year, of course, we don't have Q4 results. Here we are now, March, early April, and we're going to start getting results. We did get Q4 results in January, February. But either way, the market multiple has gone from 17.5 to 19.5. But consider the following. Tech's multiple, the technology sector, was 22. It's now almost 30. The NDX was 21. It's now 29. And the SOX, the PE multiple was 16 on Gen 1. It's 24 now. So markets are meant to look ahead. They are discounting magazines, all the things that everyone knows. But a lot has been discounted or priced in, meaning these numbers have to be good for this to stay where it is. But if they're not good or not good enough, I just don't see any other way forward than multiple contraction from here.
Multiple contraction, Dan, but also earnings and revenue contractions as well. I mean, so it again, people are paying up now thinking that we're going to get to the other side of this, and they're front running what they deem to be the inevitable Fed rate cuts in the back half of this year, which I don't know, maybe they come to fruition, but Fed rate cuts are not going to be, I don't think, the salve that everybody seems to think they are. And maybe it's not people doing this. Maybe it's just the rise of the machines and you're just interpreting words and data and those types of things. But I will tell you, this is not an environment, I don't think, to be paying a premium multiple for things that are in contraction and for a very highly cyclical space, which is capital intensive in forms of a technology at a time when credit is going to get tightened. Anyway, back to you, Dan.
Yeah, no, I think that's correct. And, you know, the way we started the show, you know, we're like, I don't really think we're being dogmatic. You know, we're thinking about like these different cycles that we've been through and let's say pre-recessionary cycles and how risk assets respond. And, you know, you think about a VIX that's, you know, 19 right here. And then you think about the volatility that we've seen in treasury yields, in FX, in commodities. You know, there's something, you know, the chickens have to come home to roost sooner or later. And so, you know, 19, 18, those have been good levels to sell stocks since the start of 2022. So I'm sticking to my guns for all the reasons Guy just mentioned. All right, Carter, walk us through the S&P chart here, what you're seeing. And again, you know, you know, listen, you divorced the fundamentals, as you call them. You had a great April Fool's joke that you sent out to Worth Charting about that you were basically just going to, you know, you're disregarding charts. You're just going over the fundamentals here. But that was obviously a joke on Saturday. Talk to us about the S&P, what you're seeing,
Sure.
and what we should be focused on.
This first chart, I included it because it says nothing. That's the point. Like, if it didn't say SPX on the top, it doesn't have to say Worth Charting on the bottom. It was just the lines that you see, and you thought it was a sneaker company or a software company or a home builder. There's not much about this setup that would make you say, geez, I gotta buy that. Conversely, to be fair, there's not much about this setup that would make you say, at least make me say, I got to sell that. It's sort of a moment of equilibrium. It's finding its footing. It's finding its way. But let's take it back a bit further and put some lines in. So the question in this is it. Are we up against the downtrend line, which you annotated earlier and discussed? We are. Now, does it have to fail here? No. Has it come a long way? Yes. Is it at a level where the fundamentals, if and as they are not robust, will cause it to fail here? Yes. Let's look at a longer term and put it all in perspective. This is the entire channel in which the S&P has been ascending since the financial crisis low. You see the peak in 2007, you see the trough, you see the COVID low, and we blew out through the top, which you can see there in late 2021. And at that moment, the multiples are almost as high as the dot-com peak at price to sales, price to earnings for the S&P. And now we're just sitting here at the midpoint, kind of walking along the line. I mean, the best case scenario to my eye is that we continue to sort of limp along in a general upward trajectory. But I don't see anything about this chart which would suggest great move to the upside. And the third scenario, of course, is that it just ultimately decays further and gets into the lower band. That's my thinking.
Yeah, and it's interesting. If we could go back to Carter's chart, which illustrates that pennant. I mean, here we are, right? So again, if you didn't know what it was, what would you be inclined to do here? So if you're playing for a breakout, Dan, I think you're looking to get back to maybe the levels that we saw back in December, which I want to say, what was that, 4180 or thereabouts? I might be off by a little bit, but effectively that's what we're talking about. I mean, do you have a hope to get back to levels we saw a year and a half or so ago? I'm hard pressed to believe that given the environment. So it would make, the logic suggests we run out of steam here. And today's dichotomy, which is a very good word, you know, you see the Dow up significantly, but you see the NASDAQ down as significantly, if not more on a percentage basis, the S&P flat. And you're saying, you know, maybe this is the level where NASDAQ starts to underperform, and that's when the S&P basically exhausts itself. So that's how I'm interpreting this. I'm not suggesting I'm right, but that's how I look at it, Dan.
Yeah, and that's kind of my trade right here. I actually moved from the QQQ short last week to the XLQ because 40% of that is Apple and Microsoft, and that Apple move, that 33% move off of those January lows is it almost looks like a parabolic line in a straight line. And I think there's going to be a give back, and given how much that is off of its 200-day moving average and all the excitement in Microsoft or regarding Chat GPT, I think those are the things that, have the ability to come in a couple turns on the multiple, especially if earnings and guidance aren't particularly great towards the end of the month. Carter, this Bloomberg Commodity Index, you put out a note on Friday, and I think it's really important. There's a lot of people who just don't buy into technical analysis, and we've talked about this a lot with you. These are fundamental people who are just like, they're kind of old school or whatever, but you demonstrate time and time again how the technicals often lead fundamental news.
Right.
Okay?
Actually, just for a second, let me just address that. I'm with you. I didn't believe in it either, but one day someone shows you, hey, pay attention to this for a second. It's not their fault. The people who don't believe in it, it's not your fault. I'll address you right now. You just have never seen the answer. You need to spend time and learn about it, and then you will accept it. I can attest to this. I have hundreds over 30 years, institutional portfolio managers running tens of billions of dollars at pension plans, endowments, who said, I don't want to be in this meeting. The salesman has made me come. You have 5 minutes. And guess what? One after another have been converted. It has nothing to do with me. It could have been another technician. If you don't know, don't close your eyes to it. Spend some time on it and you'll learn a lot.
Well, yeah, I mean, it's one of the reasons why it's important, like on a day like today, to kind of highlight the note that you put out on Friday afternoon that's timestamped. I mean, like it literally is timestamped about the Bloomberg Commodity Index. And let's talk about this for a second, because interestingly, I'm looking at the makeup of it. 16% of it is gold now, and then about 15% is crude oil, Brent, and WTI, which I think is really interesting, Guy, because isn't it your recollection that crude has often made up, it's been the largest component of that index, and the fact that you guys have both been bullish of gold, you've had a nice move in that thing, it is kind of equal weighted to that of crude. So talk to us, Carter, a little bit about what you were seeing last week, why you wanted to highlight this, and then you see a move in crude like this, which has got to be one of the biggest moves in a couple of years.
Well, sure. So obviously it had nothing to do with OPEC cutting. And of course, that's just a convenient thing for anyone who happened to talk about commodities Friday morning. But we're in the 1 year anniversary of the spike in commodities. That spike you see there. In fact, look at the next chart. It sort of iterates it. There are the arrows. That spike, and let's do one more, and you can see the decline. That is the Ukraine invasion, right? Nickel, which was the big move, a 5-fold increase. Russia controls nickel. And now that's March of 22. Here we are, March of 23. And that's a fairly unrelenting decline. And we also have the equal and opposite circumstance. At the high, crude was 140 a barrel. Wall Street predicted 200. And they predicted nickel will never stop, et cetera, and so forth. Now we have the opposite. Everyone's bearish on commodities. And when you get everyone on one side, it's usually right to take the other side. So the thinking was that this is a fairly extreme move in terms of magnitude, 30%, duration, a year. And then if we keep going on some of these charts, you'll see the sell-off where it leaves the index. So take a look at the next iteration. Well, first of all, this, of course, it's almost a 50% retracement. Halfway, you see the COVID low, you see the peak of the Ukraine invasion high. We've almost retraced half of that entire move. And then the next iteration, and from there, look at this. This is longer term. The next one, look at where we're down to, a level of support. Let's put in a green arrow. I mean, let's pull it back even further. Does it have to find support here? No, but you're at a level, a 1 year sell-off, down almost 30% to a level of support. Should we press it short here? No, I think if one has been short, cover, and then let's make a small long bet.
Live to fight another day. And, you talked about this last week, obviously, and I'll say this, we have seen cuts from OPEC before, and you have not had the commensurate move on the back of it because of the way the market might have been set up. Maybe the market was anticipating all the different times they cut with a rally into it. This time, quite the opposite. Clearly, it caught the market offsides given the magnitude of the move, but it also shows you, to Carter's point, in my opinion, how overdone things got, and the level that we reached was no longer a place you wanted to press. Now I think you do have shorts covering. And Dan, I think the next iteration will be when people try to start to get themselves long again. And I think that's sort of what's going on in gold in terms of getting long. And I think that's what's going to happen in some of these energy products. You're clearly seeing it in the underlying stocks.
And it's true in response to the bank sell-off. I mean, copper didn't plunge. It was down, but not a lot. Nickel or corn or soybeans, but literally oil went from 82 to like 62 in like 10 sessions. Way overdone. And this just happens to be the bounce.
All right, let's talk about a bounce in an individual name that was to the tune of about 100% from the January lows, but it's still down. This is Tesla, obviously, we're talking about. Tesla topped out in late 2021 at $414. It got as low as 101 in January. Right now, it's trading at 194, just broke that a little bit to the downside. The much anticipated deliveries for Q1, they came in at 423,000. I think consensus estimates and the guidance they gave was about 430. After such a big run, the stock also was up 7% on Friday into this. I think some investors are disappointed. I'm short the stock, okay, and I'm long puts. And I, playing for a pullback maybe towards that $150 level. But listen, they've cut prices twice in the last few months here, and the deliveries from Q4 were up 4%. So it's telling you that there's some demand issues here, and might there be another price cut? So Carter, talk to us about the technicals, because I'm looking at your chart, the first chart here, that obviously is a very well defined downtrend, but would you have loved to have seen this thing kiss the upper band of that downtrend and had greater conviction, maybe if you were looking to play for a move lower? Or talk to us a little bit about what you're seeing in the charts in Tesla.
Well, to your point, it is very well defined, right? Those are mathematically parallel lines. I didn't make them fit. I used a function that gives you two parallel lines. And so you have a stock that we all know dropped 75%, 400 plus to 100. But what's most remarkable, of course, is that it was 150 or 200 even, and it plunges by half and recovers up 100% back to 200. We're at an inherently difficult level, but to your point, we're not all the way back to the upper band of the downtrend. Let's put some arrows in just to annotate how precise this is. So do we have to get to that final arrow? Not necessarily. My thinking here would be short, and if and as it continues to climb, goes against you, press your shorts.
Yeah, and if you try to take emotion out of the equation when it comes to this, it's interesting. We talk about, listen, it's pretty well versed, Dan's feelings about Elon Musk and Tesla and stuff. And what I learned in the early days of fast money is you could say something negative about somebody's kids and they wouldn't bat an eye. But if you were to say something negative about Apple, even remotely, the hate mail would be interesting, and that's made its way to Twitter. And now that's true with Tesla. But again, if you take emotion out of the equation, a month and a half or so ago, when it was a $215 stock, collectively we sat here and said, look, it would make sense, given this move, to have a 50% retracement back to 165. As a matter of fact, I want to say it was March 10th. Don't at me if I'm off by a day. We actually traded down, I think, 163.86, bounced that day, and now here we are. But the bounce to the levels we just saw, we failed to get to the recent highs. So I think Carter's right. It doesn't necessarily need to get there. And I think this thing starts to trend lower. This is sort of the news cycle or the news peg people were waiting for. And clearly, in terms of the stock today, at least, people are disappointed, Dan.
Yeah, I mean, listen, again, the stock ran up, like Friday, like that. And that was actually painful for me. I actually doubled up my position, and I'm going to take a little off. And so for some of you guys who think that I've just been short, I think it was on CNBC in late January, and I said at 160 after the earnings, that's where I started shorting it, and it, obviously went up to $200 and something. I was trading around it. I've detailed it on here how I've been trading around it. I've been using options. Also, I've been using the TSLQ, and it's been a good trading vehicle. And so, am I down on it this year? Yeah, man. But you know what? I was also leaning into it at $300 last year. So it's been a great trading stock to me. I feel like that 2 price cuts, both China and here, and the looming recession that I feel pretty confident that we're going to have. Not being an economist, I think there's no way that this company doesn't avoid, further deceleration in both pricing, margins, and the stock price. So that's my take. I am a bit emotional about it, but my emotion has actually served me pretty decently in the trading of it. So there you go, people. All right, Carter Worth of Worth Charting. We had an epic Saturday night. We had an epic Monday market call. We'll see you back here on Wednesday. Thanks so much for doing all this work for us.
You bet. See you Wednesday.
I was hoping that somebody came up to him and said, "Aren't you the no emojis, no hearts, just charts guy?" But apparently
didn't happen. We were a little late. We got in there after he was into no surrender. So like all of Carter's fans didn't get to see him in the halls of MSG. So thanks, Carter. We'll see you soon, buddy. All right. Hey, guys, before we get out of here, let's hit a couple things really quickly. I want to hit the KRE. This is the regional bank index. And, again, we've been focusing a lot on financials. It's pretty fascinating that the KRE is down 1.5% today. And the XLF is basically unchanged here. So we've had the XLF came down pretty hard in the throes of the initial kind of Silicon Valley Bank and the First Republic and all that sort of stuff. But it's caught a bid. It's gone from like 30 to 32. This is one that I am short of. I'm long puts in. I really do think that we're going to have some issues when we get to the money center bank earnings. I just think that the guidance is going to be weak. I think there's going to be pressure on cash return here. But let's look at the KRE, the 1 year. It really feels like it's about to make a new year low. This is the 5 year at a really big level. What are your thoughts right here? And there's also been a lot of focus on Schwab. You were on CNBC's last call at 7 o'clock on Friday afternoon. Our friend Max Myers and Sully. It was a great program, great hit. Look at this thing, guy. It's below 52. It's making new lows. And you'd think that thing would, I don't know, man, find a bottom sooner or later. And I just don't know how that doesn't get reflected ultimately in the XLF.
There's no bounce. There's some individual names that have bounced, but if you look at these ETFs, there's really been no meaningful bounce against a tape that's obviously, to the point we've been making earlier, it's done pretty well. So I think the banks are telling you something, and I find it fascinating. And this is not directed at any one individual, but so many people will talk about how the banks lead and the banks were so strong and the broader market should then follow. But when it's reversed, they say, well, the banks don't have as much import as they used to. You really can't have it both ways. I mean, if you think about it, and we talk about this, credit and capital drives everything. So much of this economy is predicated on that. And, you think about these banks are going to be challenged going forward, given what happened. Credit is going to tighten. I'm just telling you, and their ability to make money will be affected by that. So almost by definition, their earnings are going to start to contract. And that's not bullish. So you could say, yeah, valuation, book value, all that stuff. I get it. You look at this chart and it doesn't, to the blind eye, we should have bounced from those levels, and there's been no bounce whatsoever, Dan.
Yeah, and to your point on credit, and we've been talking about Blackstone, I think since October, November of last year, they have what they call their BREIT. This is the Blackstone Real Estate Investment Trust. They had to put gates up in the fall.
Yeah, why did they have to put gates? And I'm not meaning to interrupt, but Danny Moses alluded to this. Didn't allude to it. He spoke to it on our podcast that dropped on Friday. That actually would have been a run, but for the fact that they were able to put those said gates up. Back to you.
Yeah, well, I guess that's the point here. And when you look at this downtrend, guy, literally, it's just about as well defined as it gets. We saw the stock Blackstone crescendo into year end. That might have been tax loss selling, a whole host of other things. A massive rally right back to that downtrend. It got above its 200-day moving average. It failed. It's below that. And if you look at that support level that we've drawn, it's really from the pre-COVID highs, and you know, that's about $65 here. So here we are, we're just under 85 or so. I mean, I think you have a retest of the low 70s coming in this thing. And again, keep an eye on these headlines. If you're talking about credit, it seems like there's a lot of focus on, you know, office REITs, right? And so if you keep seeing defaults or gates being put up in some of these REITs, I just don't know how the money center banks don't follow suit after that. So that's my 2 cents. Last thing, Guy, before we get out of here, look at this Apple chart. And you just said, listen, just so you know, people, Guy never talks shit about anybody's kids. He's an absolute mensch to most young people that I know here. But the fact that you felt that you would probably get more hate mail about talking some smack about Apple on CNBC than you would if you said somebody's kid is lazy. Look at this chart. This is from its highs in January of 2022 here. You see where it failed. You see that 200-day moving average where it is. It's below that very steep uptrend. It would have been absolutely beautiful if it could have gotten to 169 or so. This is what Carter was saying also in the Tesla. Your take on Apple, if it were to have one last push, it's going to be a retest of that uptrend and possibly the 200-day coming.
It's interesting, you know, when things were at their weakest recently is when Apple started gaining steam again. And, you know, that flight to perceived quality in the form of Apple and some of these other big tech names has typically been the precursor to another broader sell-off. So this is, in my opinion, I look at this and the last couple of weeks have been sort of this last gas move. By the way, we thought the stock could go down to 125. We said, buy it when it gets there. Well, guess what? Where it traded down to. I did not think, if I'm being honest, which I am, we'd see a move to these levels. So I thought maybe we get back to 150 or so. And we did that in short order. But the second leg hires caught me off guard. But it makes sense. You know, this, again, perceived flight to quality is what's going on. But Apple's not impervious to what's going on in the broader economies globally. I mean, they make shit that people want to buy. It's really that simple. And you can talk to them about install base and all that stuff.
Yeah.
I get it. They get rewarded for that in the form of their multiple, which is expensive in this environment.
Well, here, maybe Jacob can put this tweet up really quickly. This is from the Macro Alf, who's actually been on Market Call. Yeah, no, he has. And this is some data from JP Morgan. Let's see if you can get this up here. He's saying JP Morgan shows how the rate of U.S. excess savings is likely to be totally depleted by June of 2023. And, you know, again, I mean, you and I are not highlighting this stuff because we take any pleasure. I mean, listen, we run a small business and, you know, we have families. We live in an expensive place, high tax district, you know, this, that, the other thing. I mean, you know, we're feeling a lot of the same pressures that everyone else is feeling. And sometimes because we're, you know, in this group of people, if you're watching this, who are focused on the markets and we're trading and we're investing, and sometimes you kind of divorce from the reality of just everyday folks, right? Like and you talk a lot about this, but these are all things that, you know, are like getting worse before we've even had the recession declared. And, you know, what's that saying that you have about a recession? It's a recession if your neighbor loses
his or her job. It's a depression when you lose yours. That's as old as, you know, that goes back to probably the Eisenhower administration. By the way, I voted for Ike back in the day. Back to you.
So you're saying you liked Ike.
No doubt about it. If you recall, see, you went down this road, not I, but Arthur Fonzarelli was campaigning for Eisenhower against Richie Cunningham, who I think if I'm not mistaken, he was running against Adlai Stevenson, not Fonzie, General Eisenhower. So Richie was a big Adlai Stevenson guy, and Fonzie's basically, he came up on stage and said, "I like Ike. My bike likes Ike." And that was his campaign. And as it turns out, it worked because obviously Eisenhower won. Back to you.
Yeah, that's a fact. I missed that show. You know,
you miss it, or you missed that show.
No, you know what? It was good old fashioned fun back then. You know what I mean? Like, you know what's funny? Like back then, the sitcoms. My parents, when I was growing up in the '80s, Guy, they used to hate all the sitcoms on TV because they thought all the people did was make fun of each other. You know what I mean? Kind of look to belittle it. And, you know, as a parent now, I look at that sort of stuff and I agree. And I thought Happy Days was trying to have a lot of fun with stuff. So I appreciate that. Maybe Jacob can throw this tweet up right here. So So people, you might have noticed I have a new Twitter handle. It's at Dan Nathan RR. I got bounced off of Twitter, my at risk reversal handle. And if you go to this new Twitter handle of mine, you can see why I made an April Fool's joke. But this is somebody, this tweet, we're just going to highlight this. This is Stugotz44, which I freaking love that handle, guy, at Stugotz44. I mean, come on. And he's saying, on a dope scale of 1 to 10, you are a billion. So Stugotz44, thank you, sir. I appreciate that, buddy.
I'm clearly, is that your, what do they call that? Like that avatar thing? Your avatar is him, even though it's.
So what happened was I made an April Fool's joke. Okay. So April Fool's is April 1st every year, guy. You can take that to the bank. Okay. Yeah. And so a lot of people on the internet, they make these jokes, they do these things, this and that, whatever. So back in January, I was on CNBC's Fast Money. I was talking about Tesla, and Elon Musk responded to the video saying that this guy is a doofus, meaning me, this guy. He called me a doofus. Okay. And he said he believes everything that is written about him in the media. So as an April Fool's joke on Saturday, I quote tweeted that tweet that he had about me, calling me a doofus, and I made a good old-fashioned joke. And then, within an hour or so, my account is permanently suspended, and I didn't think that was very nice, but it is what it is. Now I'm at Dan Nathan, at RR, Dan Nathan RR. So follow it, people, enjoy it, have a ball.
So I got to follow that now.
You don't follow me? You don't? That is a snub of all snubs.
No, well, no, I was following you before. Do I just get sort of grandfathered in?
No, I mean, it's a new account, it is.
So I have to find it. That's what you're saying.
But what's interesting about that, and I'll just say this.
This works. I mean,
I'll just say this, okay? Supposedly Elon Musk paid $44 billion for Twitter in the name of free speech. And if you troll him on Twitter in a way that he or Twitter, support or safety or trust and safety don't like, you get suspended. I've been on Twitter since March of 2011. I have been contributing content on a daily basis since then, with a lot of engagement. You and I have been doing a lot of stuff, and I just think it's kind of funny, like that seems like not in the ethos of free speech. So it is what it is, Elon. It is your platform. You can do whatever you want with it. You paid $44 billion in October. You got a bunch of banks to lend you $13 billion to help you do it. You got a bunch of your friends, all the technorati, all those libertarian geniuses out there to kind of pony up a bunch of equity. And then last week, you just marked down the value, supposedly, this was reported, I think, by The Information, of that company that you paid $44 billion for in October to $20 billion. So you obviously know best what's right for the platform. So have at it, buddy. Enjoy.
Was that a rot? Was that what that's called?
Well, I mean, listen, I also saw something on Twitter, obviously, which is kind of meta. And I don't mean the Facebook guy, but it's kind of meta, that the Guinness Book of World Records, I guess he's lost more money than any human on the planet Earth. And so maybe if he finally gets his ass over to Mars, he will not only have lost more money than anybody on planet Earth, but also who has approached Mars. So
wow,
that's like that.
Well, it's like one of those records, like it's interesting. I mean, now I'm going down. Cy Young has 2 records that will never be broken in baseball, and he has the most wins of all time. That's 511. And Elon Musk, to your point, was probably the wealthiest man of all time at one point. Yeah. And Cy Young also has the most losses of all time as a pitcher, as any pitcher. And to your point just now, Elon Musk has now lost more money than anybody. So it's interesting. You can have both those platitudes, if you may.
And I want to make a really. Let's bring it back to the markets for a second. I know we got to go here. Are you jackassing into the city for Fast Money today, guy, or no?
No, I am not. I have to actually go shave and comb my hair. Somebody was commenting on my hair.
You have a little time. So it's really interesting. We had Josh Brown and Michael Batnick of Compound and Friends. We just call them the Compound Pod Bros. They were on with you and me last week. So that is in the On the Tape podcast feed, so you can find it there. And we were talking about Cathie Wood, right? And so she's obviously been a huge proponent of Tesla, Bitcoin, a bunch of what I'm just going to do air quotes here, innovative tech. And we were talking about her performance, and Josh said in 1 year, I think it was 2021, All 6 of her funds doubled. That's never happened in the mutual fund business ever. But it's interesting. If you think about how much all of her ETFs are down from the all-time highs in 2021, okay? So from peak assets, okay, she's lost like 80%. So she's lost more money than she's ever made collectively for any investor. Like, think about that. And you want to say to her, she's a genius. She's doing something good in the markets because she has that record. And so it's really funny about Tesla and all these people. Like, the assumption is that most stocks that go down 75%, like once they reach a certain market cap, never, ever go back to those all-time highs or take years. And if you think about the NASDAQ, it took 14 years to get back to its bubble highs. So for all of these people who are so convinced, because Tesla's gone from 101 in January to 192.5, where it is right now, that it's going to be back to its old, like thing, down from $414. Okay. Like, actually, there's a much higher probability that my $150 target in the near term is much greater than 240, in my opinion. Okay. So it's just kind of interesting when you think about it. There was that guy who had the big short, and I'm not talking about Burry, who is I'm totally spacing on that guy. Oh, Paulson, right? Who made the big bet. He lost more money from peak assets. Okay. Like after the financial crisis. I mean, the list, Citadel, okay, like lost 50% from peak assets, you know what I mean, into the financial crisis. So again, you want to say it's genius. A lot of returns are about luck, you know what I mean? And so that's one of the reasons why I think you and I sit here. We love chatting stocks. We love chatting markets. We're not your broker. We're not your hedge fund manager. We're not your RIA. We're not claiming to be any of that stuff. We're just calling balls and strikes. And now we got a little bit of a faster situation in the batter's box here. We're just going to keep doing it, guy. How did you feel about that?
Nice job. By the way, Matrix of Compassion was comparing Elon to the great Kent Tekulve for you 70s baseball fans out there. Kent Tekulve probably weighed, there it is, about 145 pounds. I mean, it's amazing that he was able to do what he did for the period of time that he did it. For the Pirates of Pittsburgh, if memory serves, Dan, but I know you're not interested. That's neither here nor there. I will tell you what's not happening tonight. As I started the show, the University of Miami will not be playing in the national championship game. What a shame. Such a storied institution. If you went there, I apologize. Not really. But that's it for Market Call, Dan. I want to thank, obviously, FactSet, financial data and analytics powered by Tomorrow. They're also our data provider. Please subscribe to our YouTube channel. Smash the beep out of the like button if you like it. I want to obviously thank Carter Worth and the audience that is here making comments left and right. I'm sorry I didn't get to any today. Tomorrow will just be the two of us on a CME day, Dan Nathan.
Yeah, it will be. All right, we'll do it tomorrow. Thanks, everybody, for joining us. Thanks for my little rot or allowing me to do that. Maybe there'll be a couple more of those this week, guy. That's just showing our max frustration with the markets here. And usually when we do that, we're within a day or so of a top. So enjoy, people. Thanks.